This is Andrew Stotz of Stotz Investment Research, looking at China, in particular China A shares, which I see as attractive due to good price momentum and a low beta when it comes to comparing against other markets in Asia. So let's get into it. I look at 4 parts. Let's start with the GDP of the country. Based upon now, unfortunately, with China, we get long lead times before we get the real GDP growth. So if we look at the 2015 GDP growth, it's about 6.88%. And what we can see from that is it's relatively fast growth relative to other countries, but of course slow to their long-term history. Now, all pillars are contributing to GDP. Private consumption is contributing the most at 2.68. So nearly almost half of the GDP is coming from that. Now, no real laggards, but net exports contributed the least at just 1% of the total, nearly 7% GDP growth. Let's move on to the overall market in the upper right-hand corner. And what we can see about this is the population, 1.4 billion people. Blah, my goodness. And we can see that per capita GDP is about nearly $8,000. That has accelerated over the last 10 years to be above most other countries in the region. And the market cap is about $8 trillion. And we can see that the size of the market is only 75% compared to the overall GDP. And GDP, you could say, is actually not in value terms, is not as huge as it can be over time. There's 3,226 listed companies in the market. And what we can see is China A has started to pick up relative to Asia ex-Japan in terms of price. You can see the yellow line there going up. Now, EPS growth is expected to pick up after a relatively poor 2015 and 2016. Consensus forecast shows 22.5% growth for analysts, what analysts are expecting. Now, analysts tend to be very optimistic, not only in China, but around the world. So we could probably comfortably say that maybe 10% earnings growth in 2017 and another 10% in 2018 could be realistic. All right, let's move on and let's take a look at our Stotz 4 elements, which ranks the country relative to other countries in Asia. And what we'll see is that the country is moderately attractive ranked at about an 8. That blue bar, if it was to extend to 10, it would be the most attractive in Asia. Now, fundamentals are just moderate. They're average. ROE has been in line with Asia ex-Japan. And valuation is moderate due to relatively high PE. Now, keep in mind that the bank sector is a large part of the market and is trading at very low PEs. So when we say that the market has a high PE, if we were actually to back out the banks, we would see that it's even higher. So the market's not super cheap at this point. Now, momentum, good price momentum and high expected EPS growth relative to other countries in the region. And the risk is, well, it has a low beta to the Asia ex-Japan market, so risk is very, very low. Of course, part of the reason is because many investors can't invest in China A shares because they're not allowed to yet. But one day, China A shares will be open to investors around the world. Otherwise, this is focused on the Chinese individuals who can invest there. Now, let's take a look at the share price performance of the market, which has been a bit brutal. We can see that, first of all, remember I said that financials were a large part of the market. They're 24%. Industrials are 18%, and consumer discretionary is 12%. What we can see from this is the best sector has been consumer staples, which is up basically just flat, and the company Fujian Anjoy Foods was up 53%. And there was another company that was down 50%, 51%. That was the materials company called Xinjiang Qinsong Building Materials and Chemicals Group, down about 51%. So there you have it for China. If you want to become a better investor, well, just get access to our additional resources and research and articles by joining our free newsletter at becomeabetterinvestor.net/join, and I will see you there.